Let's start with the region, with Asia. Where do you see the best opportunities for the second half in this region?
Well, I think there are so many, frankly, at the moment. I mean, obviously what's going on with China, and that's why we've got our third annual China Summit going on here with investors and corporates from all over China. Tremendous opportunity. I think the growth in India is obviously something which is very exciting. Last couple of years under Modi has been a real change of tone and action in India. And across the rest of Asia, Southeast Asia growing most economies 4 to 5%. Indonesia at the core of that, and then Australia and Korea. So we see non-Japan Asia, a number of areas that are very interesting. And then, of course, we have a huge business in Japan. And it's kind of interesting. You saw the numbers this morning coming out of Japan. And finally, we're seeing some life in the Japanese economy.
And you noted and you cited in your first quarter results strength from the Asian trading part of the business. What are your clients asking for now? What are you hearing from your Asian clients now?
Well, I think, right now people are trying to unravel the conundrum where globally the economic picture looks relatively robust. Globally, the political and geopolitical picture looks relatively unstable. And how does one trade in that environment? I think that's whether it's investors in Asia, frankly, or Europe or the US, it's no different.
When you look at China, are you satisfied with the pace of liberalization around the capital markets here?
That's a very good question. I mean, you've got to start with just how's the Chinese economy doing. And a lot of people focus on the fact it has slowed down from 9–10% a few years ago to 7% and now maybe 6.5–6%. I focus on the size of the economy. The Chinese economy is a $10 trillion economy. It's the second largest economy in the world. The rest of the world would die to have growth rates of, north of 3%, let alone 6%. So number one, the economy is still doing well. Consumption has risen, which is an important domestic driver. Obviously, the leadership changes are coming up towards the end of this year, but leadership has been stable. Consumption is increasing. Overall GDP growth of north of 6%. And there has been liberalization of the capital markets. I mean, the Connects, Shanghai Connect, etc., have been very positive in introducing capital flows in and out of China. More to be done, but good first steps.
If there was one development that you could push for from regulators here, one thing that could change your business prospects in China, what would it be?
Well, we have a joint venture here with Washington Securities, and we're increasing our ownership. We have an application to increase our ownership up to 49%. Obviously, as just selfishly, from Morgan Stanley's perspective, the one thing would be to get to a majority stake and have a fully owned, fully fledged business in China.
And what are you hearing from regulators? Is there any suggestion, when you sit down and talk with them, that they are looking at changing the 50-50 JV structure?
I don't want to get ahead of that. That wouldn't be fair. But I think the fact that we've been able to, we're in the path of increasing our stake to near 50% is a positive step. But clearly, as this market continues to open, continues to provide more transparency, these are the kinds of things Western corporations are looking for. Greater control of the businesses and the equity they have in this market.
Probably a question of timing then.
I think so. I think this is sort of inexorable. The opening up of the capital markets has begun, and it's hard to put that genie back in the bottle.
And if we focus now on Morgan Stanley in the business, and you've been pushing, of course, this turnaround plan. As part of that, you've had this $1 billion cost-cutting program. Where are we in that? Can you give us an update? Are you close to finalizing that program?
Well, that was something we called Project Streamline, and it was more common sense. I mean, just reducing complexity in our business, from the number of servers we have to the number of data centers we have, things of that nature. So we're well through towards the goals of that, but we're going to continue to be disciplined in managing expenses. But I wouldn't see that as a core strategic driver. It's just, frankly, good housekeeping.
And part of that was cutting back in the fixed income trading part of the business. You cut the headcount by about 25%.
Yeah.
But earnings have been pretty strong the last few quarters. So how did you manage that with fewer staff?
Well, it's a tough business, fixed income, and it continues to be. And it's probably the most volatile business any of the investment banks have. For us, it was one of our smaller businesses. And we just decided with the amount of balance sheet capital, headcount expense against what we saw the revenue opportunity, they were out of balance. And we made a very aggressive move, the leadership in that business did, at the end of 2015, I think it was, to cut 25% of the headcount. We didn't anticipate the kind of revenue we've had in the last couple of quarters. Our target was $1 billion a quarter, and we've done over $1.5 billion last quarter. But I frankly don't put too much stock in that. I'm more interested in how the business performs over the long term. If we consistently generate about $1 billion in revenue a quarter, then we will approve the concept of what we want in terms of right-sizing that business.
And is that a template for other parts of the business?
I don't think so. I think you've got to look at every business has its own economic drivers. For example, wealth management is essentially a scale-driven business. So size and scale demonstrably drive economic performance. M&A is a skill-based business where, frankly, having the best advisors in the most important corporate transaction in history is absolutely critical. Equity capital markets is all about pricing, distribution, brand capability, experience. We took Alibaba, Facebook, Agricultural Bank of China, Public. These are huge transactions. You can't fake that. So you have to look at each business and what are the economic drivers behind its performance. In fixed income, balance sheet, capital, headcount, compensation costs, all of those things had to be put against where we saw the revenue opportunity.
Is there further scope for headcount reduction?
I don't think so. I don't see. I mean, we've got 55,000 people, so I'm sure on any given day there's ins and outs. In fact, I just got an email last night from our new summer interns. We have 1,300 summer interns starting this week. In fact, I'm back in New York next week, and I'll be addressing them. We'll be bringing in over 1,000 analysts and associates, also full-time. So we're constantly looking for talented people. But the basic reshaping of the firm that has taken place over 5 to 8 years or so, that's essentially done, and we feel good about it.
Let me ask you about some of the trading activity we saw yesterday in the bank. Some of your rivals seeing their share price fall on reductions in their forecasts around trading revenues, saying that there is now a weaker, a softer environment. Are you feeling the same impact? Is that trading volume, trading revenue starting to weaken as well for Morgan Stanley?
Well, I think it would be hard to be an anomaly. I mean, we're all in the same markets. We all have similar clients, if not the same clients in some cases, where we share clients. The environment towards the end of the first quarter has bled into this quarter. There's no question about that. How that plays out over the next 4 or 6 weeks as the quarter finishes remains to be seen. But, it's an environment where it's a very interesting environment. There's enormous uncertainty, which typically would breed tremendous volatility, and it's not. There's this very passive perspective that investors have, and I think the downside risk at this point is outweighing the upside risk. So people are just not that active. That can change very quickly. I mean, we've seen it, and we've got the UK elections coming up. We've got things coming out of the White House every day. There are plenty of opportunities to trigger a turn in the trading environment, but I think I saw some of our peers' comments overnight, and they're reflecting reality. I don't think we're very different from reality. It's
about a lack of volatility and essentially clients keeping cash on the sidelines.
It's a lack of engagement. I mean, people are disinclined to take a firm view at this point, and it's unusual. I mean, we're seeing very subdued activity, yet certainly the political backdrop is quite uncertain. So it's an unusual period. It won't last. I'm not particularly troubled by it. I don't get too caught up in trading activity month by month. And I think our peers were just expressing reality.
Well, I want to get your thoughts on the politics later, after this question, about return on equity, because you do have a target for ROE of around 9 to 11% by the end of the year, or for full year. Is that target on track?
Well, we were at 10.5% on the first quarter, so I'd say we're quite well on track. But, I don't expect necessarily every quarter to hit the target. What I care about is the overall performance of the firm. We wanted to demonstrate to our investors that with very high capital levels, because your ROE is a function of the numerator and denominator, earnings over equity, and with very high equity, which we have, $70 billion of equity, one of the best capitalized large banks in the world, I think in the top 2 or 3, could we generate a return of 9 to 11%? And we believe we could. We certainly did in the first quarter. There'll be some sawtooth, I'm sure, through the year, but we're pretty comfortable with the outlook.
And just sticking to this region as well, you've got the partnership with Mitsubishi UFJ. What's the progress on that? And does it provide a template, potentially, for other partnerships, other tie-ups?
Actually, I've never been asked that before. Because it's such a unique partnership. But the core of it was a preferred investment that they made. We converted that to common around 2012, I think. And on the back of that, created 2 joint venture structures in Japan, one in the trading businesses, one in the advisory businesses. Japan is the third largest economy in the world. It's still a $4 trillion economy, so having a major presence in that market is a huge positive for Morgan Stanley. So you'd have to, in terms of replicating, you'd have to say, where else in the world are there economic opportunities of that size? Where else can you not do it on your own easily? So you'd need a partner. And then could you structure that kind of partnership with a very long-term player? I mean, the thing I love about MUFG is that they're very patient long-term folks. And we have 2 directors on our board. We have tremendous relationships at the top of the houses. And we've done over 500 transactions together. So it would be, honestly, it'd be hard to replicate that.
It's about the synchronization and then access to their client base as well.
It's also culture. I mean, you know, banks don't necessarily play well together in sandboxes. And to have the leading Japanese financial institution with one of the leading US financial institutions in a major equity partnership. They own 22% of Morgan Stanley and have created these ventures in Japan is really pretty unique. In fact, I'm sure it hasn't happened before, a cross-border equity investment of this size and the complexity of the transaction. So to me, it all starts with culture and with trust. Nobu Hirano, their CEO, is a very good friend of mine now. He's sat on our board for a number of years, and we trust each other completely.
Switching focus to your home market, given the scandals in the
Australia
White House,
or the US?
I should say the US.
Okay.
Given the scandals, all the controversy in the White House, how confident are you that Trump and the administration can execute their plans, whether that's tax reform or infrastructure spending?
You know, I think everybody's sort of adopting a bit of a wait and see, and that's part of the pause in the market, and I think part of what explains the lack of activity. You know, the administration came out with a very bold agenda. Repeal and replace Obamacare, introduce major tax cuts, redo trade negotiations across NAFTA, China, the European Union, reassess NATO and defense spending, reassess climate change and the implications for the U.S., encourage companies to bring jobs back to the U.S. rather than offshoring. I mean, this is a world of legislative and regulatory change potentially. And not surprisingly, for a new administration, it's been tough sledding. I mean, they've had to get their own house in order, so to speak. And I think the disappointment of the replacement to Obamacare, the fact that there was more work done, frankly, on the repeal than on the replace, has sort of set back the agenda a little bit. I mean, listen, for the broader economy, we hope the administration can pull some of this stuff together, because we need progress on some of these legislative programs.
Are you concerned about the U.S. economy?
No, I'm very encouraged about the U.S. economy. You know, the sort of dirty little secret here is the U.S. economy is doing just fine, right? We're at almost full employment, 4.6%, I think, unemployment rate. There's very little inflation, but we're starting to see early signs of it. We've endured 2 rate increases and expect to have more. The consumer debt is a little high, but housing prices have recovered from the crisis. State and local government deficits are under better control. So the U.S. economy, I mean, if you look at it objectively, the U.S. economy is doing fine. Not great, but fine.
There is that political risk. Do you think markets are not pricing in that political risk? Are they looking overvalued now, U.S. stocks?
No, I don't think they're overvalued. I think, you know, they're obviously trading at relatively high multiples, but look at the earnings. I mean, I don't know the exact earnings numbers coming out of the last quarter, but I think they're up 10, 12% year over year. That's pretty sporty, right? So you've got to look at the market reflects the NPV of future cash flows, not the past. And the future cash flows are suggestive of a growing economy. And in that environment, you know, people are surprised the markets reaches all-time highs. I like to point out, by definition, with the same multiple in a growing economy, every day you should reach an all-time high. That's not a surprise. That's an expected outcome. So the question is, are we getting there because the multiples have been inflated, or are we getting there because earnings expectations are growing, or are we getting there because there's just a lot of froth in the market? And I think right now, I don't see tremendous upside without further confirmation of the earnings story, but I certainly don't see an overvalued market at this point.
Very quickly on Brexit, any updates on your plans?
how can we be quick on that? We need half an hour. Not really. I mean, we're disappointed Brexit happened. We like the rule of law in the UK. We like having our businesses there. We like the regulatory environment. We'll do what we need to do as and when we get better clarity.